Hello everybody, it's Michael and Coco here. You're watching the Stock Market Brief Show. This is the show where we use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. I don't typically have my camera on, but we wanted to say hi. It's been so long since I turned it on. What a wild week in the markets. We got a lot to discuss. I know a lot of people are going to be wanting to chase this. I know a lot of people are going to be wanting to short it. We're going to cover both aspects of it and some things that I see. I'm also going to bring you around the world. We're going to be looking at some international ETFs. Let's just go ahead and get into today's episode. All right, everybody, welcome back. We're going to start here at the market dashboard. What a wild week, right? So what really took place here? Well, a couple things I want to call out, right? This is the safety trade where we look at relative performance of, gold over the SPY, utilities over the SPY, XLP over the SPY, bonds over the SPY, and so forth down the list. And what you'll notice is here, well, we've been kind of coming off hard and fast. So they've been performing under the SPY, and that makes sense given the current context of the market. What do I mean? Well, when you take a look at what the market did this last week, you get to see big bright green squares amongst all the big mega cap names. So Microsoft, Apple, Google, Amazon, and Tesla was up massively, up almost 14% on the week. Now, a lot of people are wondering, like, is this the bottom? Is the bottom in? Well, definitely potentially a short-term bottom, but we can't rule out more volatility, right? Volatility goes both ways. It goes up and down. And given the context of this week, it's very bullish. We can get some continuation, but keep in mind what the year-to-date market looks like. All right, don't just forget what's going on year to date. Year to date, Tesla's still down 14%, Microsoft's still down, Apple's still down, Google's still down. The market will set itself back up again. Look at Netflix, it's down 36% still. The market will set itself back up again, so don't make any, quick judgment calls based off of, a couple rally days. There's a saying, don't shorten the hole. Well, also there's a saying, just don't chase, right? There's probably a better one than that. But if we take a look at the 11 sectors that make up the S&P 500 week-to-date performance, look at the three horsemen up here. Consumer, discretionary, tech, and financials led the way. When you have that happen, the market's going to do very well. If these are at the bottom of the list altogether, the market's going to have a very, very bad week or day as well. And then towards the bottom of the list, you can see the only sector that was down in the red was energy. So it begs the question, so the S&P 500 really started ripping, Nasdaq stocks, everything ripped. Energy was down. So was this fall in oil this past couple of weeks what really helped the SPY? Well, if you just take a look here at this chart, well, the market, oil, has been ripping like this, right? Pretty much, into 2022 and beyond, right? Actually, let's just go to 2022. So 2022 is right here, bam, pretty much vertical, right? What did the S&P 500 do? Well, the market go down, right? It went down. So this big rapid rate of change put pressure on the market. It put pressure on transportation stocks as well. And well, now it's backing off. And now what we're starting to see is the market start to rally. So it begs the question, if oil wants to continue to rise, if you are bullish oil and you think oil is going to be going higher, right? This is a big blow off. Now we're kind of pulling back. If it's going to go higher, is the S&P 500 going to follow with it like this? Or is the S&P 500 going to stall out a little bit more and we're going to see continued more volatility? Well, you got to understand this right here, the volatility is still here. And if the volatility is still here, it's probably going to be still here too. That's the S&P 500 below us, all right? Let's take a quick look at the 11 sectors that make up the S&P 500 in candle glance form here. And really what I want to call out, this is, in descending order, starting with the strongest RSI down to the weakest RSI. And, one thing that stood out to me right out of the gate is this. If you look at the moving averages, right, the red is the 50, the blue is the 20. So when the 20 is below the 50, meaning blue is below the red, it's technically in a neutral to downtrend. And everything is basically in a neutral to downtrend except for two things. Energy, right? So you see the blue above the red, and there's a nice, flow between the two. And what you'll see here is price action, it's pulling back and it's kind of flagging right here. So if this continues to hold, energy can get some continued strength, and we might see, very same situation that we've been seeing in the markets, right? Where right now what we saw was a big run up, right? Consumer discretionary, that's the S&P 500, technology, boom. But it's a big rip in a downtrend, all right? In bear markets, they do rallies like this. If we take a look at utilities, this just had a bullish crossover with the 20 crossing over the 50, and then you can see it's just relatively flagging here, consolidating sideways. We did see some strength in healthcare too as well, especially medical supplies. That industry started doing very well, so we broke out of this with a little positive divergence. Same thing with industrials, which we talked about with the BP chart in prior episodes. So there is still reasons to be concerned in this current market. What you want to see is you don't want to see the market have these large moves time and time again, because that is what happens in bear markets. You want to see this calm down a little bit and then start to just, kind of drift itself up higher and higher. But big, strong moves to the upside, if it keeps continuing, it's going to get digested and faded at some point where you typically see 50% retracements of those type of moves. It's very likely to see that. Now, if we take a look at the rotation graph of the 11 sectors that make up the S&P 500, they're still there in the lagging quadrant. By they are still there, I mean XLK and consumer discretionary. Consumer staples is still in the leading quadrant. Utilities is still seeing strength. Consumer staples is backing off. Energy is curling, but still by far the strongest. And healthcare is also starting to move up there too as well. Okay, if we take a look at dollar performance, dollar was relatively unchanged for the most part. It backed off a little bit. S&P 500 rallied, okay, but still it remains pretty strong right here. It's still above that 20-day moving average. I would say there'd be more concern if we start really just breaking down. By concern, I mean concern in the dollar being a bullish kind of trend there. If it starts breaking, overall it's still higher highs, higher lows. If this breaks down, that could still very well serve up the S&P 500 to see some continued rallies there too as well. But the reason why I'm a little concerned here is because the dollar still remains pretty bid. And if the dollar remains bid and it starts moving higher, that could very well put pressure on, various equities and indices, also potentially commodities too as well. All right, let's go ahead and hop into the S&P 500. We're going to dive into that, looking at the weekly price chart. Everyone's going to be talking about that nice big bullish engulfing candle. It's the first week where we closed above the 5-week moving average, but not only that, we got back above the 10-week moving average too, when we closed right at about the 40-week moving average, which is the 200-day moving average. So very big bullish week. This type of move, we typically can see some more upside. So we'll look at different case scenarios of how we can play this if you miss this move, or even if you caught it, how you can potentially look at this. I'll give you some insight to what I'm thinking. RSI is back above 52, so this looks overall very strong so far. But remember, we're really just going sideways, right? So it's a trend, right? So we have, boom, we broke out, we hit the upper range, we came out, we back tested, and we came back down to the lower range. And now we're coming right back up into the middle range. So it's nothing to get overly excited about at this particular point in time. We could even imagine it coming right back up here, then just reverting right back down. Right? And we just see constant, what we saw basically in the IWM for an entire year. All right, so don't rule anything out at this particular point in time. When we get into the smaller time frames, it'll help us out a little bit more. Let's look at the weekly risk ranges. We closed more than a standard deviation, almost 2 standard deviations out of last week's range. So 405 was the lower range, 435 was the lower range, the upper range. Now, what I find so interesting about what took place is on Thursday's video, we made a guess of what could take place Friday. The guess was a higher high and a higher low. There was still, in my opinion, there was more risk to the downside than there was to the upside. And what's so crazy is there was a $5 expected move, okay? And look what happened pre-market. Pre-market, right? So this is Thursday going into Friday. It came all the way down. So 441 all the way down to around just 435 and some change. Tagged it perfectly, and then started moving up intraday. I actually posted this on Twitter because what I noticed was it started coiling up, and I said that is highly unlikely, but don't rule it out, being it was quad witching, that if we start breaking above 441, which was yesterday's high or the prior day's high, it could very well perpetuate itself higher. Now, I was thinking that unlikely to hit the upper risk range, but it did close right up there, right around 445, 446, this area up in here. So very, very strong performance in the S&P 500. Now, where are the risk ranges now? It's pricing in next week a $10, almost $11 expected move. Now, 68% of the time, it ends up closing within there. It's been doing that, and it's been on point. This last week, it closed a couple deviations out, and when we get outside, we can see extended moves. So last week, there's a lot of volatility. What can potentially happen this week? Well, first and foremost, if it comes up to 455, first thing, if it get right out of the gate, it's going to be very overextended chart. And we'll get into some indicators here, but there's prior resistance right up in that area and prior support too as well. okay? What I would like to see is this move to calm down and come to the lower range. And I'd like to see it hit the lower range just fast and quick. Monday, Tuesday, right around there, because that right there would be a nice digestion of a move. And even if it comes down further, you can order and then pick up on the way up and do something like that. And if it does something like that, what you'll start hearing people say is, it's an inverse head and shoulder, right? They'll go left shoulder, right head, and then right shoulder build out. And that's what you'll hear everyone say. And then that breakout would take us to all-time highs. Okay, that would be the script going into next week. We'll see if that is the case. And that could still be the case even if we, close up a little bit further, like right out of the gates. Okay, just know that if we come out of the gate screaming, let's look at the 15-minute chart to show you, what that might look like. So first and foremost, this is a move that you do not want to ignore, right? This is a very aggressive and volatile move. And if you're paying close attention to what the chart looks like here on the smaller time frames, every big move got digested at some point. That move, whether it be up or down, right? Down to up. So down and then got faded up. So if you think that this is just going to go all the way up through the screen and break your top of your computer monitor, think again. It's going to get reversed at some point, and it's likely with all of this chop up in here and this big volume profile right here, if you look at that as a distribution, it is likely to come back down here at some point again. I don't know when that is or if it's going to be out of the gates, but coming back to 435 or in this area, maybe not next week, maybe the week after, it's likely to see that. It's likely to see this digested. Now, on a good note, the 5-day moving average is starting to curl up. We're getting a little extended from it. And remember, it's frequently tagged, right? So here it was tagged, here it was tagged. So it's likely to get tagged again, but where is it going to be when it gets tagged? I don't know, maybe it is going to be right around here. So if it does come down and start pulling down, look at the 5-day moving average to potentially act as an area of support where you can hedge long again, right? I'll talk about my short position once we get into the Nasdaq chart, but that's what I'm looking at here now. It's pricing in a $10 expected move. I would be willing to actually go long at the lower range here. I'm also willing to take off some of my longs if it reaches the upper range. So I still have longs on at this particular point in time. So I've caught this move, right? And I plan on pulling profits. I pulled profits off on this move, but I would pull off more profits if it completely goes vertical, and then I would just wait to re-enter on a pullback. Let's look at the Nasdaq. Nasdaq 100, bullish engulfing candle there too as well. It was up 8.35% on the week. Now keep in mind, we still have wind at our face, but it's starting to curl over. That's positive. RSI is still below that 50 marker, and for the first week of 2022, back above that 5 EMA. That's very, very bullish. We have been discussing that. Now, being that it's already up 8.35%, is this thing going to just take off for another 8.35%? Well, this market's crazy, so don't rule anything out. But understand there's geopolitical risks. There's all different types of headwinds, right? We have seasonality on our side right now, but understand we're going into the second quarter here soon, right? We're not even in the second quarter yet, and chances are we're walking into slowing growth. And what takes place then, it's not typically great for tech stocks. So to see these type of rallies, what you want to see, okay, we'll look at the daily time frame. What you want to see is up days, but just not this big time and time again, because this looks like a rip your face off bear market rally. Now it came right into that 50-day moving average, still below the 200-day. This is still declining. So to think that it's just not going to digest is crazy. It's going to digest. It can go like this, but then it can go just like this. All right. So be mindful of that. Volatility is still here. It's pricing in $11.19 expected move. What does that look like? Around 340 to the downside, right around just below 365 to the upside. Okay. So how can you play this if you believe the bottom is in? Now, I'm not going to say that the bottom's in yet, but I will say probably going into next week, that's probably the bottom. I don't think I would be insane, absolutely crazy for next week to see this bottom taken out. That would be, I don't think it's likely, but unless it's something crazy news hits the tape, that is going to be the bottom probably for a while now. A week, maybe 2 weeks. I don't know. We'll see how this next week plays out. So If we hit the lower range here and you need a better entry long, that could be a potential area, right? So if it comes back down, right, and then potentially sets up for some sort of a bounce, or if it comes out of the weekly risk range and then you want to just say, well, if it goes further, I don't want to take that long chance. You can just say, well, when it comes back above, I'll have my order picked up and then potentially head higher. Keep in mind, if it does that, it's very similar to the S&P 500, where everyone's going to start saying it's an inverse head and shoulders with a neckline that looks like this, and then if it blasts off, it can take us right back up to 385. Don't rule it out. I guarantee you that's going to happen if that takes place. I promise you. Okay, we're just trying to get ahead of it right now. Qs on the 15-minute time frame, extended, very extended, right? So very strong move. So if you're entering right here, you must have a long-term look, right? If you're a short-term trader or even medium-term and you want a better entry, why would you enter here? Even if it goes up and you're like, see, I missed it. Okay, if it goes from here to here, I be careful. Now, what am I doing right now? So I have long stocks, or I have long positions on right now. I just recently went short the Qs, and I did it almost into close. A little bit before close. So I'm down on the position. Now, why did I go short? Now, a lot of people are going to say, oh, you're bearish now. No, I still have long positions on, right? So you can be bullish and bearish at the same time. The thing is, when you have a long book, right, a long and short book, so you're playing long and short, when price goes up like this, you want to take advantage of taking some profits off your long positions, okay? So your long positions. Now, if the price goes completely vertical, now, if you want to hedge those longs, you can start looking for potential short positions. Now, when I short, I typically use half of what my positions are. So if a full position for me was 6%, which it's not, it's a lot higher than that. But if a full position, this is actually a quarter position for me. If a quarter position is 6%, what would shorting a quarter position look like to me? Well, on shorts, I'm typically half of it. Okay. And then if I use leverage short, I'm even half of that. So then I'm like at 1.5%. Okay, so keep in mind if you leverage long, or when I use leverage, it's typically just to increase. It's to get exposure into that area, but it's to have a larger cash balance at the side for if something bigger sets up. Okay, it's an opportunity that I don't want to miss. Okay, so I went short. If this market continues to move up, which it definitely looks like it can, that's not going to bother me. What I'll do is I can take some more off of my longs and then hold that short position. Because in my opinion, I think that it's more likely to come down here, especially after this extended move. Now, if it starts coming down, I'd probably be exiting some of my short position right at the lower risk range. So for example, all right, so I'm short the Qs. I forget the ticker. I'd have to look. PSQ or SQQQ, which is leverage. If it is a leverage, then I have a small position on. So if it comes right out of the gate, comes right down here, I'm going to be taking profits, right? You never short into the hole. I wouldn't be shorting here. All right, so I take profits on my short. Okay, and then you might see some sort of covering take place, and you could see a potential bounce if the 5-day moving average goes up. That'd be awesome, okay? And that would help my long positions too. Now, if we come way up here, I'm going to be taking profits off longs. That's what I'll do, right? And if we come up here, I'm not going to be exiting my short. I'll still hold it on. And the reason for that is because my longs help kind of mitigate that. So understand, if it gets more extended, I might even potentially add a little bit more to my short position, okay? As I take some from my long. So you got to just play it tactically, whatever way works best for you. I know I'm carrying this on as I stands right now. Huge move. Slowing momentum on the RSI, slowing momentum there on the PMO2 as well. Okay, so yeah, in my opinion, it's going to get digested at some point. We'll see when that is. And if you're bullish and you want to catch more of a move to the upside, you need to be prepared on pullbacks. Okay, and then you could manage your risk. But right here, it's a very difficult spot to just be happy with going long, other than if you're planning on holding it for multiple years, all right? Because then basically, if you're holding it for multiple years or retirement, you're just buying into the momentum strength. And then, even if we take out this low and head lower, who cares if you're holding it for a long period of time? Because at some point, we can very well cross right back through it, okay? Let's continue on to the Russell 2000. Russell 2000 on the weekly time frame. Ooh, check it out. So we were kind of curling over, right? And now we just had a big bullish move here. Now, you got to wonder, all right, we were in this channel for over a year. If this was distribution, blow off top, right? Wyckoff distribution or whatever, is the market really, I would just say, is big money investors, hedge funds, institutions, if they went through this big period of distribution, are they just going to go long again if price comes right back up here after spending all this time in distribution mode? It's hard to believe that that's the case, but what we're seeing right now is a pretty strong move. But, you know, we're still not breaking out of this, breaking back into this channel. So 210 is a very key level. All right, so 210, you can see it traded within this range. Okay, back and forth, we blew off. Okay, let me go put the middle of the range there. And then we came underneath. Are we going to come right back into 220 and then right back into the safety channel? I mean, perhaps, right? The PMO, it's still negative, but it's starting to curl back up. All right, and we're still below these key moving averages, but we just crossed above these, so that is a good sign so far. It's very likely to see some continued momentum, but 210 is still an area of resistance here, okay? RSI is still below 50. Let's take a look at the weekly risk range. Weekly risk range just below 215 on the upper end, which puts us, you know, at prior areas of resistance. So if we come up there right out of the gates, could be a good area to take some profits, and or if you're trying to be tactical, look for a short position. 205 was last week's upper range, and 187. We came through that just like all the other indices. On the lower range is 200. Okay, so if it comes right out of the gates down here, that can actually be just a nice pullback, you know, where we can potentially hedge long if you do believe that the market's going to continue to press up. And if we do get a pullback into this range and we start moving up higher, that to me does look actually pretty similar to this Wyckoff distribution, but on smaller time frames. What do I mean? Let's take a look at the 15-minute time frame. All right, so this has been going pretty much sideways, right? So a lot of open interest that's building here. Probably going to see some continued volatility and explosive moves. You can see the volume shelf. A lot of volume traded here. Now we're getting above it. Not much volume over here on the other side, so to see it shoot up, that would make sense. Now, what's interesting of this, looking on the 15-minute time frame, it's already extended, slowing momentum on the RSI and PMO. It does look similar to this, right? And if I just overlay it, which we talked about on a prior episode, you know, where you have, you know, this type of movement, what you need to see is you need to see a pullback and retest, and you need to see that hold for that to take place. Now, keep in mind, if that is the case, where can it potentially go? Is it going to go to all-time highs? I don't know. I really don't. But if we are going to continue higher, I would, on a bullish case, I think we come right back into this middle channel, which is 215 to 220. Okay, which is right where those moving averages are, pretty much, the 30 and the 40-week moving averages. So yeah, very strong overall. You know, it's a positive development, but there's still a lot of trap supply up ahead and resistance, okay? So FOMO is a no-go. Got to be careful. Let's go around the world now. I got a lot on today's episode. I tell you all kinds of stuff. So we're just taking a look here at a bunch of different international ETFs, and we have them, you know, from strong moving all the way down. And I just wanted to call out a couple different areas where you may want to look, and I pulled a couple specific charts. But Australia looking very strong, Mexico, Canada, Brazil as well. Switzerland is starting to move up a little bit there. These top four are looking pretty good, and a couple that aren't on here, I want to show you more zoomed in. But here, right here is Canada, and Canada is doing pretty darn good, right? So we're just kind of in this, chop channel, but these last couple of days, we're starting to see strength getting above 39.50. All right, so right now it's breaking out of this area of resistance, and it's up currently on the year. So this one might be one to look at on pullbacks, okay? So that's something to potentially keep your eye on there. If you take a look at Indonesia, Indonesia's forming a nice cup and breaking out of that. It didn't really form much of a handle, but this is looking pretty strong here too as well. So if we start cracking back above 2075 or just slightly above that, this could be a very good long position and to kind of just trail a stop below a 50-day or 20-day moving average. So that is one to keep a close eye on. Mexico, also, big move here. It's been very, very strong. So maybe wait for a back test to see if we can have that hold and see some continued strength. But it is breaking out of those areas of resistance, bringing it positive on the year. So looking good there. And then another one too is Africa, or more specifically, I guess, South Africa. It's also forming a nice cup right here where it has an area of resistance. Now it's kind of consolidating here. So if we do pull back to the 20-day or even just around this zone, if you're looking for a more longer term hold, hold here, at least, for, the quarter up ahead or maybe 2 quarters. I don't really know, whatever your strategy is. This one looks good to me as well. All right, so let's hop into some indicators now and kind of give you an idea of what I'm seeing and why I'm saying, okay, don't FOMO here, just be patient, okay? In times of high volatility, it's not a time where you want to make snap judgments. So let's look at some BP charts. This is the bullish percent index on the Nasdaq. That is not really an area where you want to go long. All right, so what you want to do is you want to wait it out to see if it come back down a little bit, and then use the candlestick charts to pull back into area supports, and then you could buy long. But as it stands right now, we're overextended, right? We're overextended. So when it happened, this is why I kind of put on a short position, or I started building out a short position against my current long positions, is because of that specifically. Okay, bullish percent index on the Nasdaq composite still shows that it has room to go up higher. So this could signal that we still have that extra stretch there in the composite. Now, SP 500 also moving into that overextended area. Keep in mind, overextended could stay overextended for a long period of time, but just call it out as I see it. When we get overextensions or positive divergences, it's been marked as turning points, okay? So that's how it stands there. BP for Dow Jones Industrial Average also has a little bit more room to run, but it is almost moving into that overextended area there as well. If we take a look at the Nasdaq McClellan Oscillator, it is getting very frothy here, getting into an overextended area. When we get to these levels, bam and bam here, boom, we've sold off. Bam, we sold off there too as well. So a lot of breadth coming into the market. That's a positive thing. But now it's really about finding good entries if you do believe that there's going to be more legs to this. If you do believe that there's going to be more legs to this, which, like I already stated, I don't think that this is going to get taken out next week. The only way that this is going to get taken out next week if something happens, something big happens, because that is too strong of a move to get faded in one simple week. I just highly doubt it. Okay. If we keep continuing on, the NIMO also getting overextended. This is the McClellan Oscillator for the New York Stock Exchange. When we get overextended areas, we have marked tops there too as well, where you get subtle pullbacks. This was a big one. And then I look for bullish divergences and negative divergences. So as it stands right now, it's getting a little frothy. Not exactly the place where you'd want to go long. Nasdaq New York Stock Exchange advanced decline line also been seeing a very strong move out of the gates. We took out this prior high, so that is a good sign, right? A low, higher low, high to a higher high right there. But just take a look at the internals. We reached a high to a lower high, and it's starting to point down there. So this move, like I said, can it continue to extend a little bit further? If it does, look for a potential hammer candle or inverse, because it could very well get faded at this point, okay? It's not like we haven't seen this before. Look at this move. Boom. Look at this move. Boom. Look at this move. Is this is it over? Is everything done? Maybe. It's too hard to say. So you got to be open to both cases. You got to be open to that this is the bottom and we're going to go higher and higher forever here. Or, you can be open to this aspect that this could get very well faded as well. If you take a look at the housing index, still pulling in a negative divergence there, right? So we did one here, S&P 500 fell, right? We had a lower high here, S&P 500 fell, and now we have this, that can change here coming up, but as it stands right now, S&P 500 is still showing more relative strength. So if this starts coming off, this could very well get faded and follow through too as well. So something that I also wanted to point out. If we look at this divergence too as well, we talked about this on a prior episode, so I'm not going to dig too much into it, but it's clearly a negative divergence still as it stands at this particular point in time. Now, if this comes all the way up to all-time highs, then divergence is gone. But as it stands right now, the divergence is currently holding. If we take a look at the buy and sell signal, look at the CPC, came way down. So it's got a 0.78 reading, so pretty darn bullish, that's for sure. But it's the 10-period moving average is still above 95. So if this holds down here further, that'll give us that buy signal. We'll keep an eye on it and see how that plays out. If you take a look at the old full indicator here, this one, you can see the CPC shot up, but you can still see the green line is still below the blue line. What we need to see is that crossover. That's more bullish. So as it stands right now, it looks pretty good, but it's not there yet. When it crosses over, yeah, we can see some moves up, but look at this when it crossed under. When the green went below the blue, it's been in a downtrend ever since. Okay, so it's another indicator that I like to keep an eye on. If you take a look at SPIP over GOVT, what's going on here? Well, we came back above that rate of change. Volatility is coming off a little bit, but keep in mind, could be a leading indicator of volatility to come. All right, as it stands, right, when we cross above those lines, shortly thereafter, it's not immediate. Shortly after, we saw some spikes in volatility, and what we're seeing right now is volatility actually crushing to the downside as it's crossed back above. So we'll keep an eye on that if volatility pops its little head back in. If we take a look at the VIX, right? VIX, volatility crush. So this has been good for, premium sellers, and it's been good for people that were long equities that are potentially taking in some profits. Now, people are going to wonder, where can this potentially go to for next short? I mean, it's been getting absolutely crushed. Keep in mind, like in 2022, right? We've been above 20 for quite some time. Okay, so if it came all the way down to 20 and you're looking like, okay, I want a more solid short opportunity, that could very well be it over there. But as it stands right now, we're still at a pretty elevated level at about 24. And if you look at RVX, still it's right there around 30. All right, that's Russell volatility, so it's still relatively high. It's just coming off of also a very high level. And the same thing goes with VXN, which is Nasdaq vol. It's just under 28, so still relatively high as volatility is getting crushed. So volatility is still here, people. Don't ignore that. Bonds and yields. All right, this is where it gets interesting, right? So, the stock market's doing something crazy right now and rallying, but the bond market's giving us a whole different view on things, right? So as the Fed raised its rates, right? So on the low end of the curve, the yields are coming up, and they're coming up more fast than the higher rates. So the 10-year, the 30-year, the 20-year, et cetera. Okay, so what we're seeing here is we're seeing a flattening of the curve to almost inversion, so 0.17 on the 10-2. So it continues to flatten, and we don't want that. That's not a good environment. It's not a good environment for financials. It's not a good environment for a lot of things. And it doesn't mean that the market can't continue to perpetuate up and rally, but just know that when we get inversions, it has been a very highly reliable indicator for recessions to come in the near future. If you look at 35, also getting very flat at 0.28. It almost seems that inversion is imminent here. And if we look at all the yields, sorry, not all the yields, but the majority of them, and we look at the various curves, I mean, so we look at the 10 and 2. Look at the 3 and 10. The 3 and 10 just inverted. It's at minus 0.01. So if we can hold below this multiple times, it tells us that something is wrong here. Something's going on. All right, the 5-10. It's flat, completely flat, almost inverted, right? It's at 0. It's at 0. The 10 and 7, inverted. The 30-20's been inverted. All right, and some of these are mild curves. The 3-5, inverted. Okay, so we're getting a lot of inversions. This is a big one to watch there. The 310, that inverted. Now, when I'm curious, right? I looked into this, but when it last time it inverted, it was in 2006, and then over here in 2007. That was right before the financial crisis. But keep in mind, the financial crisis, the market sold off a little bit here, and then it started rallying again, and it took basically a year, 2 years for it to actually mean anything. So understand, it's not like a snap. It happens right away. All right, but we're getting an inversion, okay? We're getting an inversion. We're moving into Q2, all right? Q2, and we're moving into slowing growth. And we're going into a tightening cycle. Don't ignore the macro factors here, right? So we're getting some strength in the markets, but there's a lot of things to be concerned about. So we're seeing volatility pick up significantly. So that tells me volatility is gonna be here to stick around. So be mindful of that. Now, I pulled this chart back even further, but I don't have it on me right now. I wanted to see the prior time, and you could look at it happened in 1998. Right? And what happened in 1998, right? So we got the inversion, and what happened? Well, hedge fund blew up, right? Long-term capital management, kapoo, exploded. All right? But then what happened shortly thereafter, right? The market sold off hard and fast, but then we melted up incredibly before an 80% drawdown, the dot-com bust. Okay, so don't get me wrong, right? David Hunter, he can still be right. He can be, right? A lot of people make fun of him, and, I get it because he's been calling a melt up, on the entire way down. But there's also people, very intelligent people that say market's topped and it's going to start rolling over now. We're moving into slowing growth. It's going to be a hard time for anything to start picking back up. So there's like tug and pull on both sides, right? And I'm not just saying David Hunter by himself is thinking this, but there's people that are very bullish. There's people that are really very bearish, okay? I say this frequently, and I heard it from Robert Kiyosaki. A coin has three sides. It has heads and it has tails, but then also it has an edge, all right? You need to stand on the edge and you need to look at both sides, heads and tails, okay? It's like the stock market. They have bulls, bears, they have wolves. People are saying they got kangaroos, all this stuff. Be a wolf. Understand both aspects, all right? If you are biased to one specific side, that's all you're going to hear on these shows. That's all you're going to hear anywhere, right? Because you're constantly looking to confirm your bias. So if you are bearish, you are going to be like, okay, he's really right here about all these bearish things, but he's wrong about this because that's bullish and that doesn't, I don't believe that. Like, cross that all out, because the thing is, the market can go either way. So it's best to understand and have a plan, an if-then statement or plan for if this happens, then I'll do this. Or if that happens, I will do that. I'm dragging that rant on, and we're coming to the conclusion here. 10-year yield starts to perpetuate higher and higher, not as much as the lower end of the yields, like 2-year, but it is still blasting off here. Could still very well perpetuate more to the upside, right? The Goldman Sachs employee, I remember ex-Goldman Sachs employee said that I can expect it in a blink of an eye going to 25, which is 2.5. And, he's not proven wrong yet, but if it starts coming off, I think it'd go to 2.5, but I think it's going to come down first beforehand. And if that's the case, then I think that obviously TLT could be a beneficiary, especially if, market participants move to more risk off here in the near future. That's just my guess, but I'm prepared for the alternative too. TYX, this is also pretty interesting. The 30-year, huge move, but then also started backing off, shooting star type candle. So is this going to start coming back in a little bit before heading higher? We'll watch that. If you take a look at TLT, the TLT, right? We've been talking about this wedge. We've been talking about the area of support. And guess what? We popped off a little bit, and I still see that we can still see if investors still want to focus more on risk off. I still think that this is a possibility to easily tag this area, right? So as he was saying, a blink of an eye to see 10-year yield move to 2.5, I think that in a blink of an eye, we can also see the TLT popping right back up to 136 in ease. So I am positioned in a TLT position here. It's not too big by any means, but I still think that there's a possibility for that to happen. So I wanted to have that at least on as a possibility if that is the case. And I look at the weekly time frame, hammer candle. So if we get above that weekly high, we can perpetuate a little bit more to the upside into that area, and you can clearly see it's been holding a support there, here, and here. Now, if we get a weekly close below that, guess what? I'm getting out of that position until further notice. All right, everybody, that was just a wild amount of data that I went over. Okay, so we went over the risk ranges, we went over around the world. To be honest with you, it looks a lot better to be focused in on around the world is doing better. At least that section, some of those countries are doing significantly better. Understand that there's different risks around the world, like currency risks and various other aspects, geopolitical risks and so forth. But they are looking very strong from a price action perspective. We had a very strong week in the markets. It looks like the markets can perpetuate itself up a little bit further, but in the short term, we are overextended. We're getting extended, all right? So if you are bullish here, just be patient, watch for those pullbacks. If we blast right off and you're like, no, he's right, then you get in, that's, that the market does crazy things, right? It does what you don't want it to do. It'll suck people in and then do the exact opposite of what you wanted. So you need to be prepared with what I said was, an if then. So if the market blasts off, out of the gates on Monday, am I going to buy in? And if so, then what am I going to do if it starts turning down on me, right? Or if the market's going to start off way lower, then I'm going to go ahead and actually put a position long because I missed that huge move. And, if perhaps I get stopped out, then I'll just wait for another level. All right, so think of it in terms of that. I think it will help out quite a bit. That's all I got for you on today's episode, everybody. Have a wonderful weekend. Cheers.